Thank you for joining us today for our Payday Super webinar. My name is Julie Schofield and it's great to have you all here. Before we dive in, I want to say how pleased we've been with the response to this topic. Over recent weeks, we've run sessions in Cooma, Bega and Moree, and they've been fantastic, really well attended, great questions and plenty of good discussion. So it's wonderful to bring this to a wider audience online. For those wondering what all the fuss is about, Payday Super is one of the biggest changes to superannuation in years. From 1 July 26, employers will need to pay employees super at the same time as they pay their wages, rather than quarterly. It's a significant shift in how payroll and super work together, and that's exactly what we're here to unpack today. To take us through it, I'm delighted to introduce our presenter, Dimity Fish. Dimity will walk through what's changing, what it means for your business, and the practical steps you can take to get ready. I'll hand over to her shortly. A few quick housekeeping items before we begin. This session is being recorded. The recording will be emailed to everyone who's registered, so don't worry if you miss anything. You'll also receive a follow-up email with the slides, some useful resources, and a feedback survey. We'd love to hear your thoughts. Please note that today's session is general information only. It's not financial, tax, legal, or workplace relations advice. This is an interactive session, so questions are welcome throughout, and we'll have a dedicated Q&A at the end to work through them. And finally, if anything comes up afterwards, please reach out to your voice advisor. They're here to answer questions and help you get set up. With that, let me hand over to Dimity.
Thanks, Julie, for the introduction, and good evening, everyone, and thanks so much for joining us tonight. We really appreciate you taking the time to be here. For those of you who have attended our previous webinars, you'll notice tonight's format is a little different. Rather than a panel covering a range of topics, this session is more technical in nature, and I'll be leading most of the discussion. I'll endeavour to keep it as engaging and practical as our previous sessions have been. I must admit, I was a little surprised when Julie asked me to present tonight, especially given that she's already been interviewed on Payday Super on a real, proper, actual podcast. So rest assured, if I get stuck, we've got the real expert here to keep things on track. So Payday Super can sound a bit daunting at first, and there's some commentary about how complex it may be, but today is about simplifying that, giving you a clear practical understanding of what's changing and how it will work day to day. From our perspective, once it's set up, this should streamline processes and reduce errors, particularly around super payments and reconciliations. There might be some adjustment early on, but over time it should just become part of your normal payroll routine. So please feel free to put any questions in the chat as we go, and we will get underway. So what we will cover today, we'll start with why Payday Super is being introduced, then we'll walk through what's changing and what's staying the same. We'll cover the new concept of qualifying earnings, what happens if super is paid late and the maximum contribution base, and finally some practical steps you can take. We'll also work through some examples on the way. What I won't be covering today is how to physically process Payday Super within your accounting software, whether that's Xero, MyOb or Phoenix. So if you do need assistance with this setup or the processing, I encourage you to reach out to your accountant. So why Payday Super? Why has the government introduced this? The main driver for this from the government for this change is because of the amount of unpaid super. It's estimated that there's $6 billion each year in super that's not paid to employees. Secondary to the unpaid super is also to improve compliance and make sure employees receive their super in a timely manner. This purple statistic was really interesting. It shows that over the long term, even small delays in super payments can add up. So, for example, a 25-year-old on medium income can be around $7,000 off better at retirement, and that's just for paying the super the day you pay the wages as opposed to 3 months down the track. It's not paying your super late, it's still complying. So, that's how we talk about compounding and the compounding effect on that. So, what's changing and what is staying the same? In simple terms, super will need to be paid at the same time as wages, and it must reach the fund within 7 business days. There is a little bit of flexibility, up to 20 business days for new employees or where contributions are rejected. This ATO Small Business Super Clearinghouse will also be retired. So businesses will need to move to a compliant software solution or a commercial clearinghouse. We still have some clients using the ATO Small Business Clearinghouse. So if you're sitting there thinking that's you, you're not alone. We just need to get you changed over to a software solution that will help. There's a new term that's being introduced called qualifying earnings. This is replacing the old OTE, so the ordinary times earnings, and I'll cover that in a bit more detail down the track. What's not changing is the super rate remains the same at 12%. Who super applies to is unchanged, and the ordinary times earnings still matters, and it sits under the qualifying earnings umbrella. Just one thing to be aware of: the super will need to be paid at the same time as wages. This may prompt some employers to consider changing their pay cycle to simplify reporting. So they might go, well, we might pay monthly instead of weekly. It's important to proceed with caution if you're going to do that, and ensure any changes are consistent with your employment contracts or any award requirements. So qualifying earnings is just what I touched on before. So you will now calculate your super based on qualifying earnings. Qualifying earnings includes the old ordinary times earnings, so payments of ordinary hours, payments of paid leave, allowances, bonuses, and lump sum payments. There's no change to that. But qualifying earnings also includes all commissions and bonuses paid to employees, directors' fees and earnings paid to workers who fall under the expanded definition of employee, including payments made to independent contractors paid for their labour. And I think it's a good opportunity for businesses to review their contractors versus employee rules, just to make sure that they're in line with if they're a deemed employee and a deemed contractor. And I'm talking a bit about that in the presentation as well. Salary sacrifice amounts that would qualify as qualifying earnings had they not been sacrificed to super. Note that this doesn't capture salary sacrifice for fringe benefits or novated lease. I have another example on that as well. Some payments may fall into more than one category of qualifying earnings, such as commissions paid. So those payments are covered only once. You don't count them twice, obviously. Qualifying earnings does not include overtime payments, expense reimbursements, termination payments, non-cash benefits, or paid parental leave. So you still don't have to pay super on those amounts. So this is an example of salary sacrifice. What this is showing us that an employee earns $100,000 a year. They salary sacrifice $10,000 into their super fund. So the employee receives super guarantee of 12% on the full $100,000 and is paid $90,000 For single touch payroll, the employee should have super guarantee of $12,000 and a reportable employee super contribution of $10,000. Now, how that differs to a novated lease is on the next column. An employee earns the same 100,000 but enters into an agreement to salary sacrifice 10,000 on a novated lease. So the employee in this case receives the super guarantee of 12% on the 90,000, not on the 100,000. So we'll just look at employers versus contractors. I've used in this case a shearing contractor. For those of you that don't know me, I'm from the Monero and there's lots of sheep on the Monero. So I've used shearing in this case, but the rules apply for any contracting relationship. So you need to pay super for a contractor if they are deemed as an employee. So what's the difference between a deemed employee and a deemed contractor? So if you're paying a shearer mainly for their labour, e.g. per hour, per day, per head, if the shearer does the work personally and you're not paying them for a specific result, for example, shear the whole mob, generally they'll be a deemed employee and you're required to pay super on that. Where they're deemed a contractor, you don't need to pay super. And that will be if the contractor can send anyone they choose to do the work. You're paying for a result. So you're paying for the contractor to come in and shear the mob. And you contract with a shearing company, partnership or trust. So if you're in a case where you've got any contractor relationship, just make sure that you review that to ensure that they're still deemed contractors. Okay, so practical timing, payday super in practice. A key point is super is not paid until the fund receives it. So timing becomes critical. You need to factor in clearinghouse processing times and aim to pay as close to payday as possible. So it's a bit of a warning here. Don't be misled by the 7-day rule. The 7 days is based on the ATO's expectation of how long it should take for the super fund to receive the contribution and allocate it to the employee's account. That means you can't rely on paying a few days later. If, for example, you wait 4 days to make payment, there may not be enough time for the fund to process that payment and match it to the employee's account, and that will incur a super guarantee charge. So this is one of the key reasons why the ATO Small Business Clearinghouse has been retired, because it's just deemed unfit for the speed and the volume of transactions required under Payday Super. Able to be allocated. This is some terminology that the ATO has created to help around what it means is that the super fund can match the contribution to the employee within 3 business days. So the key aspects of able to allocate are it prevents rejections around accurate employee data, so TFN, name, date of birth. If a fund rejects a payment due to the wrong TFN or similar, it shows it's not able to allocate, and it results in a super guarantee shortfall if it can't be rectified. So it will tell you within 3 days that they are not able to allocate that payment. And we have found recently with setting up a few clients that some of their information in Xero or MyOb has been updated, and the data matching hasn't allowed the payment to go through. So that's why we're asking you to check all your employees' details again and just make sure that you're dealing with this well and truly prior to 30 June. Another aspect of this is timing. While the employer should pay on payday, the legal deadline is for the fund to receive it and be able to allocate the contribution within 7 days. So as I talked about before, don't assume if you pay after 4 days it will be processed. Now, there is an exception. If the ATO if you're a new employee, the ATO have given you 20 days to make that first contribution, just to give you a bit more time to onboard the employee. We all know how hard it is to get some super details out of employees, so it just gives you that bit of extra time. So this screen is just on for new employees. It gives you up to 20 business days for the first super payment for a new employee, or when an employee changes funds. It doesn't remove the need for good onboarding, but most super errors happen in the first few weeks of employment. Okay, so the reporting of your payday super. So you'll need to report your qualifying earnings and your total super payroll liability in single touch payroll. Keep an eye out for the information provided by your payroll software provider. I think most of them have got this up to date and would be doing it anyway. Errors are reported quicker. If there's a problem with the super payment, you'll find out much faster from your super fund. Super funds only have 3 business days to allocate or return contributions. It used to be 20. And this means you can fix issues quickly and avoid penalties. So the super funds have their bit of work to do as well in terms of making sure that their systems are up to date to manage this. So the ATO have, they've got some technology updates. One of the technology updates that they have is SuperStream version 3. That's come out on most softwares. And what this is, it's introducing enhancements, reducing the likelihood of employee contributions being rejected by the fund. It's providing clearer error messages when a contribution is rejected. It enables faster payment of contributions by reducing banking delays, and it knows sooner when important super fund details are changing. They've also introduced the new member verification request. This allows a software to confirm the employee super account number and other details are correct before the first contribution's made. So that just prevents the rejection at the time you're trying to pay the super. It is only enacted in certain situations, new employees, change of events or prior rejections. I haven't actually seen it in practice yet, but I think it is starting to come out in some of the programs. Penalties. So this is a really interesting one. So the rules are if super is paid late, super guarantee charge applies. Now, this is not a new rule and it's not a new penalty. It's always existed. The penalties are a little harsher than they used to be. But in the past, it was up to the employer to report any outstanding super or any super paid late. It was a requirement of the employer to fill out a super guarantee statement. They'd send it to the ATO and the ATO would assess the penalties and charges. In reality or in practice, we actually didn't see that happen very often. So now through Super Payday, the ATO will govern these late payments and they will issue the penalties. And they're not very nice. So it's saying that you'll have to pay the super guarantee shortfall, and then you'll have to pay interest on the notional earnings of 10.6%. But the real kicker here is the administration fee. They're saying that they can charge up to 60% of the shortfall. So that can add up very quickly. There are voluntary disclosures that we can send off to say it was an accident, please try to remit some of this. So if we do use voluntary disclosures, we can get away. We might be able to reduce it, but it would just automatically be assessed through the ATO, and assessments will be raised. Additionally, if you then don't pay that first section, general interest charge will continue until the amounts are paid. If you don't pay that within 28 days, then you can have an additional penalty of 50% of the unpaid super guarantee. So the ATO are saying that there will be a grace period where they'll help us through this, but the penalties for paying your super will be paying your super late or not paying at all will be not very nice. The next screen is an example of how the ATO are going to allocate the payments. So what the ATO are doing is they're saying we will allocate the payments to the oldest outstanding amount first. So what this means is, in our example, Jenny's employer still owes her $1,000 in super from the April to June 26 quarter. As at 1 July, she starts processing her pay runs. So she pays her $1,000, that's $120 super, and Jenny pays the $120 super by the 8th of July. So in Jenny's mind, she's complying with the super, the payday rules. However, because the ATO are allocating the oldest payments first, what they're saying, well, that $120 will offset the $1,000 that she's owed from June. And the same with the July, that July amount will offset the $1,000. So it's not until we get to 27th of July that Jenny is caught up. So it will mean that her super has technically been paid for late for those 2 weeks. So the biggest take home from this slide is please try to pay your super prior to 30 June for the quarter ended 30 June. Like I said, the ATO there is grace periods on this, and they will look favourably on penalties, but I think let's just not go down that path if we don't need to, and let's try to pay that super prior to 30 June. So can you just go back one slide for me, please? Thanks. So in the transition period, we're just really asking everyone to try. So when we talk about transition period, we mean from now until 30 June. Cleaning up old issues before payday super starts will make life easier. Contributions made in early July might be applied against the April to June. So try to get that money, the super, paid before 30 June. Interestingly, overpayments can be carried for 12 months. I don't know in what case you would overpay your staff super, but it could be if you're paying yourself super and you want to make a lump sum payment into your super fund, you can carry it for 12 months. So that's a good option there. And as I said, the ATO will show some grace during the first year of inception, but payday super needs to become normal practice while preparing payroll. So, let's try to get it started sooner rather than later. This maximum contribution base, it's around the high income earners, so anyone earning over $250,000 a year. The maximum contribution base is now assessed annually rather than quarterly. So what that means is if let me just catch up on my screen. So once the employer pays the employee $250,000, they can stop their superannuation obligations. So it used to be as at 62,500, but now it's at the 250 mark. So if somebody gets paid bonuses or commissions early in the financial year, the super contribution guarantee might stop early for that person. It's just important that for those high income earners where the superannuation does stop getting paid, that employment contracts and awards are you're still in line with those employment contracts and awards.
Dim, I might just jump in there if that's okay. That is at the decision of the employee, not the employer. The employer can't decide to stop paying someone super because they've reached a certain limit. The employee has to actually apply to have their super to opt to receive their super in hand and get taxed at the higher rate than going into the super fund.
Yeah.
Sorry, just thought I'd add that.
No, thanks for clarifying that. That was a good point to pick up. So just a few other things to note. So immediate super guarantee liability is payable on payday for commissions and bonuses. So you have to do that the day you pay your commission, the day you pay your bonus. Back pay or correction to ordinary times earnings also creates a super guarantee liability that you have to pay immediately. Smaller or irregular payments outside the normal pay cycle still creates a qualifying earnings pay obligation, but can be included in the next regular pay cycle. So you've got a bit of discretion to use there. Super is paid at the time any leave is taken. Super is paid to casuals regardless of hours worked over 18 years of age, including loading. And super is also payable to children under 18 years of age if working 30 hours a week. We all remember the rule of $450 per month. We didn't have to pay under 18s. That rule has changed, and it's been changed for a couple of years now. It's 30 hours per week. Allowances that's directly connected to your skills, your qualifications, or your duties are qualifying earnings. So you do have to pay super on those, but expense reimbursements are outside the scope. No super is required to be paid on that. And just finally, just some practical steps. Ensure your systems are ready. Confirm your super fund and your employee details. Understand your clearinghouse time, so understand how long it's taking your super fund to clear those amounts, and monitor for your rejected payments. And we have a checklist that you can see. Use the checklist provided. This will also be emailed to you, and reach out if you need any help with setup. So that's it from me. I was able to make back a bit of time. Thank you.
Tim.
Yeah, thank you for your time tonight. And please, we're open to any questions if you'd like to put them in the chat.
I've got some questions here that I might just kick off with for you. Some questions. Yeah, no, that's fine. There's some questions coming through. I think you've answered a few of these, but it'd be good just to go back. So what happens if an employee gives me the wrong super details, and I'm thinking about like a casual that comes and does 1 or 2 days of work, and they give you the payroll details, but maybe their member number's wrong, or what can an employer do?
Yeah, so that goes back to that MVA, let me get the correct wording right.
The member verification.
Thank you.
Yeah,
yes.
request. Yeah.
So you can process that employee through your payroll, have the request done prior to you then having to pay them.
And if that request comes back wrong, what would be the next thing if the employer's gone?
Yeah, good question. You'll have to track them down. You'll have 20 days, to track them down and get the correct super fund. Mm-hmm. There is, you can probably answer this better than I can, Julie. There is the ATO super fund where you can put any money, any super into the employee super. What's that exactly called, Jules?
Yeah, so the ATO, there's an ATO unclaimed super.
Unclaimed,
yeah, so you can actually put super in there, but it's also I think, Jim, from every employer should have a default super fund. So if they set up, if an employee comes to them and they don't have a super fund, there could be a default super fund that employees can go to as well. But hopefully, you know, using the new system of the member verification request, that will sort that out. I do probably suggest people put it through the system before the person leaves leaves their farm or place of business, just so it'd be easier to talk to that employee why they're around. Lots of questions coming through here. So, okay, also in regards to backpackers, often don't have a super account set up. So that would be one of the instances we've just spoken about. Dim, would you agree?
Yes. Yeah. The default super fund. Yes.
Yeah. So set it using your employer default super fund or using the ATO unclaimed super one as well. A question here, what date is used as the trigger for the 7 days? I pay staff on 3 different days, small family business, but also lodge single touch payroll once a month. Are the 7 days from the single touch payroll lodgement day?
That is a good question. The rules are the 7 days from the date of payment. So if you're paying on different days, that will be 7 different days. But I think you will need to get into the habit of lodging single touch payroll every pay run that you do.
Yeah. I agree with that approach too, Dimity. We've just got a question. Sorry, did you want to add
I was just going to say one thing. So I wonder if you could align those pay runs. So you're not paying 3 different pay runs every week. So then you're only having to lodge your single touch payroll once a week.
Yeah. And I believe the single touch payroll is not the actual trigger point for the super to be paid. I think you've just said that. It's actually when the employee gets paid, the super must be paid. So it's not on when you lodge the STP report. Is that?
Yeah.
So what do you do when under 18s don't have a super fund? Yeah, so I'm happy to answer this one, Dim, if you want. So we've just spoken about, we really do encourage when under 18 start working is to set up their super funds. Often they will use what their parents probably tell them to use, or what they've used for themselves as well. We're getting to this environment where our kids are probably quite tech savvy and they know a little bit more about what's happening with returns, etc. So I actually do encourage children setting up their self-made super funds to actually have a look around as well. We can't exactly tell them a retail fund because that would be giving financial advice, but the technical answer is an employer should have a default super fund, and that default is used in the case that your employee doesn't have a super fund and you're making that election to put that in place for employees. So I encourage employers to actually have a look what their default super fund is, and whether it's appropriate for employees, and then you can perhaps suggest that or say to your employee, we do have a default super fund, it is such and such. Other questions, I think, what do you do? What happens if an employee gives me the wrong super details? We've spoken about that. Do casuals and under 18s get super? I think you did mention that in the presentation, Dim. It's the 30 hours, isn't it?
Yeah, so all
new rule?
casuals over 18, yep, get paid super. If they're under 18, working the 30 hours in the month, required to
Terrific.
get super. Yes.
Is my software ready? And when can I start using it?
Yeah, so MyOb is ready. We already have some clients that are already starting to use it. So you should be right to set up your super. If you haven't already, some people are already doing this. They're already doing this, the MyOb or Zero. So if you're clicking into payroll, processing your pay run, going to pay super, you get a text to authenticate the super and it comes straight out of your bank account, you're actually already doing it. So it's if you're not following those processes that you'll need to go ahead and set up properly. And for the people that are already doing it, the change is you just have to do it every pay run, which a lot of people are also already doing that as well.
I have a question for myself here. Julie, can you tell us again what you spoke about the high income earners? They have to opt out of receiving super, otherwise employer has to keep paying even if super contributions amount goes over $30,000. That is correct. So what happens in a situation with high income earners is, and I'll use an example of perhaps a doctor that may work quite a few locum jobs and work for a hospital and then travels and does locums in different areas. And they earn over the income threshold, and so they would receive more than $30,000 because of their income. So, and that doctor, for example, could approach one of their employers and say, I have already received my maximum amount into my super, and there's a special form that they will need to fill out, and they actually need to opt in before I think it's in the first quarter of the financial year, to opt in to say, I would prefer to I want to receive my money and not put it into super. The consequences of that is that they would pay the tax at the higher rate. So no doubt they're on the higher rate of tax. Versus having the money go into the super fund, getting taxed at 15%, but they are also over the excess amount, so there will be an additional 15% on top of what is over the 30. It's a bit not complex, but I'm very happy to have that conversation in more detail with people that are in that circumstances as well. But it is the employee's choice, not the employer's. That's what's really important to note. I hope I've answered that question. And any more questions coming through?
Is the 12% rate changing? There's no word on changing it, is there? We haven't seen any announcement on changing that.
No, that's right. I think if there's any more questions, then I'm sure we'll please keep sending them through, because we do see them after the recording, and we're very, very, very happy to answer those questions. As Eliza said, you'll receive a recording of this at the by tonight or tomorrow morning. The recording will go out. I thank everyone for being patient with us. We did have a few technical issues for those that have joined us a bit later. We're sorry about the first invitation didn't work, so we had to send the second invitation out, but the recording will have the full session. So thanks again. If there is no more questions, we'll finish up 4 minutes early. Thanks for joining us tonight. Thanks,
Thank you very much.
Thank
Welcome. You. Good night.
Night.